Thanks very much, Harold. That's not gone unnoticed. Morning, everybody. Well, we're delighted to be here, as Harold just touched on. Neither I nor Alan have presented at this conference before. The picture we've taken for the cover chart this time is from the Axe brand, a brand that in fact started here in France. And it's to try and move an upgrade to a more sophisticated and slightly older target group, not unlike most of us here, in fact. The advertising, as you can see, features a variety of men finding their own individual magic in different ways. To be honest, I've been waiting for the call from Alan asking me to participate, but nothing yet, presumably because I don't look very good in a bath towel. As Harold said, you're getting two Scots this morning. In fact, it's two Scots from Glasgow. So in addition to the usual disclaimers, it's entirely possible you won't understand much of what we're about to say. Get the agenda up for today. Look, we want to cover three important questions, which I know are on your minds and are very key to understanding Unilever both today and tomorrow. Firstly, emerging markets. How do we view the prospects for this tremendous growth engine that we have? Secondly, how are we responding to the changing world, which is at the same time both more global but also more fragmented, and where it pays to be fast and to be nimble? What is the role of brands and innovation in helping us to compete and win against both global and local competition? Alan's going to take us through this using personal care, the category that he leads, to land his messages. Thirdly, we'll cover profitability. How are we driving efficiency and savings with programs including zero-based budgeting, and what does that mean for growth and margins going forward? Here's the usual safe harbor statement, and with that, let's get started. Before I talk about emerging markets, I want to give you a quick reminder of our strategy for long-term value creation. It's pretty simple, really. The four compass pillars, as we call them: winning through brands and innovation, winning in the marketplace, which means leveraging the scale of our portfolio, winning through continuous improvement, and winning with people. We have four differentiated category strategies that you can see here on the chart, each with their own individual set of priorities. And all of that is underpinned by the Unilever Sustainable Living Plan. Now, that's not a nice-to-have add-on, but it's a very integral part of our business strategy, securing long-term value creation by driving more growth, less waste, less risk, and more trust in our business. Our business model has proved resilient. In the unusually tough and volatile market conditions of the last 3 years, our underlying sales growth has been 4% per year, ahead of our markets. Our core operating margin has improved steadily by 30 to 40 basis points every year, and core earnings per share have grown by 11% at constant exchange rates and by 6% at current rates. Our return on invested capital has increased to 19%, and that's including goodwill and acquisitions. This underscores the good returns that we get from reinvesting in our business, both organically and through acquisition, and why this remains the priority for our use of cash. Free cash flow has increased to 4.8 billion euros, up by nearly 1 billion. More than 3 billion euros of this was paid out in dividends, with the remainder invested in acquisitions, including the prestige skincare businesses. Now, although the differentiated category strategies have been, we've been addressing areas of weaker performance. Foods has returned to growth, albeit still below our ambition, while continuing to deliver very strong margins and cash flow. Within this, our two largest brands, Knorr and Hellmann's, grew 4% and 7% respectively last year. Spreads remains a drag, and as you know, we're focused on reducing the decline while preserving the very strong cash flows through the dedicated unit we set up less than a year ago. Profitability in home care has improved by nearly 2 percentage points and is on its way to double digits. Our return on invested capital in ice cream has improved by 3 percentage points, and now it sits in the mid-teens. Growth in the developed markets has been challenging in our categories in recent years, and particularly so now with the price deflation that comes from relatively benign commodity costs and an ever more challenging retail environment. However, last year, our volume growth in developed markets improved to just over 1%. That was ahead of markets that were slightly down. This shows that we can win with innovations like the very successful dry spray deodorants in the US and Dove Advanced Hair Series on both sides of the Atlantic. Now let me turn to the first of the three themes for today, emerging markets. Let me be clear. Emerging markets have been, are, and will continue to be fundamental to Unilever's growth and value creation. Over the last 25 years, our emerging markets businesses have grown 9% per year organically, with 5% from volume and mix and 4% from price. And while this growth is inherently more volatile, volumes in aggregate have grown in emerging markets in every single one of those 25 years. Even in the current slowdown, our emerging markets business is growing. It grew by 7.1% in 2015, which included 2.7% from volume, and by 8.3% in the first quarter of this year, with 3.7% from volume, albeit against a somewhat easy comparator. We are unique in having 70% of our volume, and that is measured by cases shipped, which I believe at least is the best measure of the scale of our operations in emerging markets. Unit prices there are a bit lower, of course, so emerging markets represents 58% of our turnover today. Margins, however, are only slightly lower than those in developed markets by between 1 and 2 percentage points. So emerging markets overall contributes 55% of our EBIT. Let me try to set out for you briefly how we are achieving this growth and why we see plenty of continued opportunity in the future. First of all, our portfolio positions us well to realize the opportunities for for market development across all four categories. In total, we have a business of 30 billion euros in the emerging markets. Now, this includes 12 billion euros in personal care, growing at 7%, 8 billion euros in home care, growing at 6%, 5 billion in foods, growing at 7%, and 5 billion in refreshment, growing at 9%. The swelling number of people at middle income levels, with another 800 million expected by 2020, drives increased per capita consumption. For example, in deodorants in Asia, where the penetration across our markets is currently less than 50%, or in ice cream, where the per capita consumption in Southeast Asia is still a fraction of what it is in the United States. In fact, it's about 1/16. With greater urbanization, such a powerful global trend, there will be another 400 million people living in cities, and that means, quite simply, more kitchens and more bathrooms to be cleaned. And we can expect about 300 million more women to move into paid employment in those markets by 2020. This brings greater demand for products that offer more convenience. In home care, new formats like liquids, an increased penetration of automatic washing machines driving the need for machine specialist products, and in foods for cooking ingredients that save time preparing the family meal, as well as higher demand for Alan's personal care products. Unilever is particularly well placed to realize these opportunities. We have deep, deep roots and a strong cadre of local management. In fact, 80% of our country leadership teams are locals. This helps bring consumer understanding, but it also means high sensitivity to local market conditions. And this, combined with local P&L responsibility, helps us to manage effectively through periods of volatility and to deliver in aggregate consistency of performance. We have a portfolio that is well suited to continually compound and build scale. Many of our brands have been built over generations. Most of these are global, with a common brand purpose and benefiting from global innovations. Yet in each country, many of them are thought of as local brands, In Brazil, Omo is thought to be a Brazilian laundry brand. In Turkey, Omo is thought of as Turkish by Turkish people. We have product ranges that span across price points and consumer needs. Staying with the theme of laundry, you can see on the chart the way that consumption evolves, with increasing income levels from bars to powders to liquids, up to products like fabric conditioners and stain removers. It's the same in cooking ingredients, or in tea with the evolution from loose leaf to bags to specialty teas, or in personal care when we can start to build regime. And the scale of our portfolio across our 4 categories of everyday products brings distribution strength. It allows us to reach either directly or through distributors 8 million outlets. That's up from 4 million 6 years ago. In fact, it's because of this multi-category approach that we've been able to build the emerging markets business that we have today. Take Indonesia, where I used to work. We started out with a spine of distribution in laundry and basic foods and used this reach to build in other categories and now a very strong personal care business. This same logic applies today as we use our distribution strength to extend personal care, moving into liquid detergents, growing cooking ingredients, and expand our ice cream sales through both the modern trade and traditional retailers. Our distribution reach in emerging markets is an enduring strength, but it's never ever static. Let me give you a couple of examples of how we're extending it further. Firstly, in small stores. Those of you who came to our investor event in the Philippines and Singapore last year will have seen some of this for yourself. In Southeast Asia, 70% of our sales flow through distributors who are increasingly exclusive. And this allows us to build digital capability into our distribution networks to sustain competitive advantage or even increase it. Our lever-edge system harnesses the power of data to make our distributors more effective extensions of our sales force. In Thailand, where we first adopted leverage, we've seen an additional 170 basis points of growth. We've extended it through the rest of Southeast Asia and are now introducing the system to our distributors in Africa. So far, we've deployed it across 15 markets, encompassing 1,300 salesmen and reaching nearly 2 million outlets. Our ambition over time is to cover at least half of our indirect sales in this way. At the same time as further strengthening our traditional distribution, we're extending our distribution in channels which are new for our categories, like e-commerce. In our categories, e-commerce took off earliest in the developed markets, for example, the UK, the business I was running this time last year. It's already 7% of our sales there, and in France, a neighboring market, it's 5%. But it's been growing fastest in China, nearly doubling in each of the last few years. Here it already represents 8% of our sales, and it should be 10%, cross that boundary, by the end of the year. Growth there is supported by strong partnerships with JD.com and Alibaba. In most other countries, e-commerce is still only beginning to emerge in our categories. So overall, while it's still only just over 1% of our total global sales, it is building fast. Our online sales grew by more than 50% last year, well ahead of the market, which grew at about 20%. Now, at this stage, it's far from clear which of the various and varied business models in e-commerce will win the battle for adoption and commercial viability in the different markets. Let's take a look at India. With the emergence of marketplace retailers like Snapdeal, Paytm, Amazon, or Flipkart, grossly online models like Big Basket and Grofers, or beauty portals like Nykaa and Purple. But it doesn't stop there. Let me give you one interesting example that we're just testing in India. This is Humara Shop. Humara Shop is an online portal owned and developed by Unilever, which aims to connect shoppers with their favorite local stores in the top cities in India. It combines the convenience of online shopping with the local reach and shopper preference of the traditional trade, which represents 80% of our sales in India. Now, shoppers visit the site, select their favorite store in their local area. They can then browse through a wide range of groceries, and not just our groceries, and place their order. The order is fulfilled by their chosen local store for either pickup or for a free home delivery. Any delivery is taken care of by the retailer. Humara Shop enables us to better serve consumers, whilst also giving us data-driven insights to better understand product selection. We can use this information to optimize the promotions that we list on humarashop.com. As e-commerce takes off, this model could strengthen our extensive and deep distribution reach in India, build brand loyalty, and help the traditional trade to remain consumer relevant and competitive. Now, for now, it's just a very, very small test, and it's too early to say how big it will be. But I think it's a good example of the importance of being agile and prepared to try and experiment with new models in such a fast-changing area. So again, I hope you get the picture on the emerging markets. Although conditions are likely to remain volatile and mixed for a while yet, we are quite simply as excited as we ever have been about these markets and their demographics as a key driver of long-term value creation right across our portfolio. Let me hand over now to Alan to talk about the next theme. That's how we're going to build agility into our business and how our personal care business uses brands and innovation to compete effectively with both global and local competitors in a changing but more fragmented world.
Well, thanks very much, Graham, and good morning, everybody. It's nice to see some familiar faces, people I've met before, but for those of you I have not met, I've been looking after Unilever's personal care category since late 2014. Prior to that, I looked after our categories and businesses in Europe, North America, Africa, the Middle East, and Asia. And it's a pleasure to be here to share some of Unilever's plans to become faster, more consumer-centric, and more global and more local. And of course, this is an existential question for consumer products companies operating with the matrices that we have. It's a timeless question, more global or more local. And what I hope to show you this morning is that we don't see this as an or question. There are some things that we want to become more global, and there are other things that we want to become firmly more local. It's an and question. And I'll illustrate with our approach with a few examples from personal care. Now, Graham and I have obviously been focused on ensuring that we're well prepared for this important conference. And we've been able, as Harold politely pointed out, to do that undistracted by the antics of our National Association football team, as Scotland has once again chosen not to participate in the other important conference happening in France this month. And that's frankly all I'm going to say about the Euros today. Sorry, I would like to offer sincere good luck and best wishes to England for this evening. Anyway, a quick word on context. The overarching contextual phenomenon that we face is fragmentation. Fragmentation of consumer groups, fragmentation of media choices, fragmentation of competitors, and fragmentation of the routes to market that we can access. Consumer segments are less and less homogeneous. We now serve an increasing number of distinct groups, no longer just mums or men, but millennials or Generation S, Paulistas, Shanghainese, Muslims, Middle America, the LGBT community. And this level of micro-targeting that we're engaging in is, of course, made possible in a large part thanks to digital technology, that same technology that has permanently fragmented the incredible choice in media channels that consumers and advertisers have access to. You're not alone in the fact that you hardly ever watch conventional terrestrial television anymore. Access to lower-cost media channels, along with the fact that there's reduced barriers to entry for competition around things like capital and technology, have, of course, allowed the rise of many insightful and agile local players in our market. This has created a fragmentation of our competitive set. And finally, channel proliferation goes much beyond just e-commerce. I was talking with a group this morning about whether it's the fast-growing cash and carries of Latin America, or the fast-growing discounters of Europe, or the fast-growing proximity and convenience stores of Southeast Asia. There are multiple new types of health and beauty specialist retailers emerging across the world, and we have to be able to deal with that fragmentation too. And to make matters worse, this all happens simultaneously. So it's like a complex four-dimensional Rubik's Cube, where we might find ourselves choosing to run a campaign that addresses millennial men using social media distributed video assets, selling exclusively on e-commerce, and competing with local brands that you may never have heard of with a negligible share. So tremendous fragmentation in the world that we're working in. Now, Unilever obviously has significant global scale, but as Graham already mentioned, we also have deep local roots. And in this context of increased fragmentation, we're going to do even more to use our global scale as a competitive advantage while trying to be even more relevant locally. And let me try to illustrate our approach. We believe that some things are better leveraged globally, so we want to be even more global in things like category expertise, purpose-led brands, and R&D. You know, we're a market leader in most of the categories that we compete in, and a key priority for us is to continue to drive growth and development of those markets. We know how to do that. In emerging countries, we help children understand the benefits of hand washing. We continue to drive second and third steps in women's hair care regimes. And we have systematic programs that drive the use of conditioners and things like post-wash treatments. And we innovate at the same time to offer premium benefits at premium prices that allow us to trade markets up, like the dry spray deodorants in the US that Graham mentioned. Secondly, we do have a stable of purpose-led brands. Our sustainable living brands accounted for nearly half of Unilever's growth in 2015, and our sustainable living brands grew 30% faster than the rest of the portfolio. In fact, our 5 biggest brands in the company, Dove, Dirt Is Good, Knorr, Hellmann's, and Lipton, are all sustainable living brands with a very clear and strong purpose. And this approach is being rolled out with integrity across our portfolio. And the business case for the Unilever Sustainable Living Plan and our sustainable living brands is becoming more and more evident to us every year. Put very simply, it drives faster growth, lower cost, and more trust across all stakeholder groups. And then thirdly, product superiority and breakthrough technology does drive superior performance. And this is one of the things that we believe is also best done with global scale. The investment we make in our 6 main R&D centers around the world deliver world-class science and technology for our products. And it may interest you that today 60% of our product formulations benchmarked as superior to our competition in blind testing, compared with only 20% 5 years ago. So we're really driving and investing in product performance and product superiority. So deep category expertise, brands with a purpose-led proposition, and leveraging world-class technology seems to create a platform for faster scaling up and rolling out of winning mixes. We've got lots of examples of that. But at the same time, there are some things which are best done locally and for which we want to remain firmly local. So local consumer and cultural insight is part of Unilever's DNA. All consumer insights are local. We grew up as a decentralized business, and the depth of our roots and local cultures is something many of you have seen personally at our investor visits, market visits, most recently to the Philippines. But nevertheless, our approach to gathering insights is increasingly using sophisticated digital analytical tools. Our people data centers allow social listening around the world. We're increasingly capturing huge amounts of information about what really matters to our consumers and feeding these insights virtually in real time directly to our global and our local marketing teams. So a brand like Tresemme will know exactly what hairstyles are hot in New York Fashion Week, what people are talking about in social media, and we can respond immediately in our marketing materials with the most on-trend fashions and hairstyles. And customer engagement is also rooted in deep understanding and partnership with the local trade environment. It's our teams on the ground, in the countries, in the discussions with our partner customers where value is created. And last but by no means least, the execution of our plans and the responsibility for the P&L sits firmly in the countries. This allows us speed of dynamic response deployment to be able to quickly address opportunities and address issues and capture opportunities. Now let me try to bring this global and local approach quickly to life in personal care. As you know, PC continues to increase in importance to Unilever. Personal care now represents 38% of group sales. We remain one of the fastest growing global players, outpacing the market. We've been growing on average at 6% over the last 7 years. Our core brands and organic businesses generate the majority of that growth. But in line with our strategy, we've also acquired new premium mass brands, and as you know, we've entered the prestige luxury segment. Our strategy is quite simply to over-resource the sources of fastest growth. We believe purposeful brands are stronger brands. You already know well some of the biggest and most loved examples: Dove, tackling issues of self-esteem and body confidence; Lifebuoy, continuing its hand-washing program, helping children to live past their 5th birthday; and the repertoire of personal care brands which have got clearly articulated sustainable living purposes at their core is growing quickly. So whether it's Vaseline's healing project, or Sunsilk helping women establish their own beauty businesses, or Dermalogica helping women to achieve financial independence through entrepreneurship, or our biggest oral care brand, Pepsodent, driving twice-a-day toothbrushing, which you would be amazed is still underdeveloped in many parts of the world, or even the Fair and Lovely Foundation, helping provide scholarships for higher education, vocational and job readiness training, and career guidance to women. The list of brands that are finding their purpose in our personal care portfolio goes on. And this responds to the need for authenticity, particularly that the millennial consumer has, brands that stand for something that people really believe in and engage in. Secondly, we have strategies and activity systems to address specific high-growth consumer segments. I'll give you 2 examples. One is male grooming, which we'll talk about in a minute. But another one is the rise of the Muslim consumer around the world. And I'll talk about that in a second. Thirdly, to address the fragmentation that I've mentioned, all of our brands in the portfolio speak to consumers through both traditional and new media, and through traditional and new channels and routes to market. We have to be able to deal with that fragmented landscape. So let me bring each of these points to life with one illustration. First, brands with purpose. Dove, as you know, has been an award-winning brand with purpose for many years. It's the biggest brand in our personal care portfolio, and you've seen lots of examples, highly emotionally resonant examples of our global work for many years. But what we've observed is that there are very significant nuances around the issue of women's self-esteem globally. And the Dove team are working with our biggest growth markets to produce hyper-local insights and programs. And I'd like to share with you now an example from India. Can we run the first video, please?
Isn't it strange that in a country of 631 million women, there is still only one face of beauty, when there is so much more to be admired? Let's break the rules of beauty.
So obviously a very Indian take on Dove's proposition, and you see here one asset. It may interest you that we produced over 1,000 assets to support this campaign, which is live right now, ranging from traditional TV and print, but also online video, social media posts, banner advertising, in complete partnership between the global Dove team and the local Indian business. It's early days in the campaign, but the response has been so far quite overwhelming. We have tons more examples. Time prevents me from sharing them, but watch this space for a particularly inspiring one on Dove in Brazil shortly. High-growth consumer segments. The Muslim middle class is young, increasingly affluent, connected, and growing very quickly. We have strong positions in all the majority Muslim countries in the world, and we're now delivering brands and innovation that address specific functional and emotional needs of Muslim women. The example shown here is a range of Sunsilk products that specifically meet the hair care needs of hijab wearers. This particular visual is from Indonesia, where the local climate and the growing incidence of wearing the hijab has changed our understanding of what girls and women really need for their hair. Our global science base has delivered the technologies that can offer new and more relevant hair benefits, and we're seeing terrific results. And this approach against the Muslim consumer is being deployed actively for our hair, our skin, and our oral care categories. And happy Ramadan, everyone. We're in the middle of Ramadan right now. And finally, a multi-channel approach. The most recent innovation from Axe is a great example of a multi-channel approach. Young men in particular hardly watch terrestrial television at all these days. And for the global launch of its range of new male grooming products, Axe has invited consumers to shed traditional and outdated notions of masculinity, to embrace what it means to be a man in the modern world. And it turns out that this very on-trend proposition resonates and is nuanced locally in many markets. The global campaign is called Find Your Magic. It uses online video in particular and a series of digital assets. And what I'd like to do is show the next video, which is what the digital video to support this campaign. Next video, please.
Come on, a six-pack? Who needs a six-pack when you got the nose? Or a nose when you got the suit? Now you don't need a suit when you got the moves. Or moves when you got the fire. Or fire when you rock those heels. And heels when you ride those wheels. Looks, man, who needs looks when you got the books? Or books when you got a cause? And who needs all that when you get the door? When you got the dough, the brains, the that's right. Who needs some other thing when you got your thing? Now work on it.
Now, I know you're not mainly marketing professionals, but I'm sure you'll agree this feels more in touch with modern expressions of masculinity. And you'll notice that Axe is no longer portraying women in an inappropriate or objectified way. This is an important part of us moving our brands forward and keeping up with the times in a global and local way. So, our plan to become in some ways more global and in other ways more local is supported by an organization-wide change program which we're calling Connected for Growth. It encompasses how we work together, how we upskill our teams, and how we roll out some new ways of collaborative working. We are evolving our organization. We're making it even more consumer-centric, fast-moving, and simple. A higher proportion of our marketing resource will be located close to markets, and each brand will strengthen its global network with each marketer who works, for example, on Rexona being only one click away from every other marketer in the world who works on Rexona, as well as the global brand leader of Rexona. Capability-wise, we're in the second phase of our multi-year digital capability skill-building program, mandatory for all marketers in Unilever. We are, of course, putting in place the tools and technologies that we need to execute this plan. And I must say, being a marketer in the modern world requires quite a high degree of sophistication around things like people data centers, how we develop content for mobile advertising, how we support our brands and e-commerce platforms. These are significant changes, all part of this Connected for Growth program. It's preparing our company for the future. ready to drive our brands and our plans to be both more global and more local, to be more agile, more digitally connected. So I hope I've shown you that at Unilever we don't see it as a trade-off between global and local. Quite simply, there are some elements of our business where we want to leverage global scale and some elements of our business where we want to leverage more consumer and customer proximity locally. Thanks for your attention. Let me hand over to Graham to wrap up with the third element of our talk on profitability. Thanks.
Thanks, Alan. Thank you. So yeah, the third and final area we want to touch on today is how we're driving profitable growth. And you've heard us say this many times, but our model is one of 4G growth, and that's growth that's consistent, it's competitive, it's profitable, and it's responsible. Fundamental to delivering against this model is continuous improvement in our efficiency and our cost base. This fuels reinvestment in growth opportunities, and it underpins the steady improvement in our operating margin. We've been making good progress over the last 3 years. Our gross margin has improved by 200 basis points, helped by positive mix change, an ongoing supply chain improvement program that delivers €1 billion a year of savings. The program is very well established, and it will continue around this level for the next few years. The savings here, though, largely help to offset cost inflation, reduce the need for pricing, so that we can make our products more competitive every year. Project HALF delivered more than the targeted €500 million of savings and brought overheads down by 80 basis points. In advertising, more efficient spend on production and agency fees has saved around €200 million. Now, that's been fully invested behind the increase in digital advertising, behind our brands, and behind our innovations. All of this has underpinned continued growth ahead of our markets and an increase in core operating margin of more than 100 basis points over the last 3 years. But continuous improvement means continually raising the bar, and that's why we're now running a zero-based budgeting program to help us unlock the next round of efficiency savings. I'm sometimes asked by investors when I meet them whether it's a good fit for Unilever. My answer is definite. It's a definite and a rousing yes. Our approach is an integral part of our 4G growth model. Now, that isn't meant to be a play on words with 3G, but it is worth distinguishing where our approach and philosophy might differ a little bit with theirs, and ZBB is a good example of this. It's focused on value and growth. It's not predicated on taking all identified savings to the bottom line, but making informed choices, more informed choices, about where we choose to redirect our resources or continue to invest above the benchmarks. We will not cut to the bone in areas which drive growth. For example, we already invest above the benchmarks in R&D and consumer insight, and we'll continue to do that. Where we do make savings, the decisions of how much to invest behind growth and new capabilities will be taken on a case-by-case basis. It's very fact-based, ZBB. The program so far has been focused on data gathering and cleansing and comparisons with benchmarks. Call it visibility. It's driven by experienced business leaders in the business. It creates a constructive tension of challenge over what we spend, where we spend it, and why we spend it. It takes us from a solely vertical management of cost to horizontal and vertical cost management, and it brings in that constructive challenge and constructive tension. And it's just the right time for such a deep analysis and review of what we spend, as our industry is changing so fast and old paradigms and assumptions about where to invest need to be constantly challenged. We're working with Accenture. They bring a wealth of experience, program management and benchmarks from the other ZBB programs that they've run. And I thought I'd share with you today just a few of the conclusions coming out of that visibility phase that we've just completed. First, it's confirmed that overall and in many of the individual areas, our spend is already below the median of our peers. But even so, there are plenty of opportunities to eliminate waste. This chart illustrates this with just a few simple examples. We spend less than most of our peers on travel, particularly air travel, but we do spend substantially more on taxis. It's not unusual these days for the cost of the taxis to and from the airport to be more than the cost of the flight itself. In the area of consumer promotions, there's a high cost of repacking products such as banded packs and gift packs. We can improve the efficiency of that process by feeding in more digital promotions like free airtime that cut out the need for that physical repacking process that drives a lot of waste. And while market research is absolutely fundamental to our growth model, we can reduce the amount that we spend on continuous research and leverage digital methods to focus more on finding deeper consumer insights. As I say, these are just a few simple examples to illustrate the approach. The work done so far has confirmed to us that our ZBB program, together with the organizational changes that Alan touched on, should deliver the expected savings of at least €1 billion in overheads and marketing by 2018. The savings are going to be realised across all of our 4 categories. How we deploy these savings is and will be determined by the individual category strategies, which are referred to at the start of the presentation. In aggregate, we expect the savings to underpin continued competitive top-line growth ahead of our markets and steady year-on-year margin improvement. It's worth remembering that, unlike many other companies, we absorb the associated restructuring costs within our core operating margin measure. If we have a period of higher restructuring to access a higher rate of savings, we will also absorb that, but we'll let you know that we've done it. So in summary, we've got a resilient business model. Oops, I've gone too far. Resilient business model that's delivering consistent results in challenging conditions, and we've been addressing our areas of historical underperformance. We remain very optimistic about the potential for profitable growth in the emerging markets. We're adapting to a world which is getting both more global and more local. We're strengthening our global brands and innovation, whilst at the same time increasing our agility in local markets. We're making some fundamental changes in the way we're organized and our marketing capabilities to be more connected and fit for a digital world. And zero-based budgeting is helping us to drive the next wave of savings in our business. These will be partly taken to the bottom line and partly reinvested in the business behind clear and differentiated category strategies. We're confident that this is a recipe for sustainable value creation for our shareholders for a long, long time to come. And with that, we'll take some questions.
Well, we've got a few minutes for questions, and it's the break after, so we can probably afford to slightly overrun. Are there any questions? Well, I'll probably ask the first question then. If we look at recent quarters, your emerging market performance, whether it be volume or organic growth, has actually been, frankly, excellent, high single digits overall. How come that is possible at a time when, I take the newspaper in the morning, Brazil is awful, China's not great. How are you doing so well in emerging markets at a time when everything suggests they're not good?
So the usual drivers, but Harold, fundamentally, there's a very, very nice portfolio effect that exists in our emerging markets. We have broad spread of emerging market presence. Our largest single emerging market it's 6% of our business. So we've got broad exposure, and actually one of the features that has been a very strong feature, and we've talked often about it over the last 2 or 3 years, has been the extent of the variation within the emerging markets themselves. We've just talked about emerging markets in aggregate, but that's probably the only time you'll find us doing it, because it's not very meaningful at the end of the day to understand what's going on. For example, just to look at emerging markets today, over the last 25 years, our emerging markets have grown at 9%, about 4% from price, 5% from volume. Broadly speaking, the 4% from price gets largely eroded in terms of currency devaluations when you go back to hard currency. But the level of price growth in emerging markets today is sitting at 4.4% in the first quarter, 3.7% of volume growth, and that was a step up from 2.7% last year. So you're right, good momentum pulling into the emerging markets. But that 4.4% of price looks quite different to the way it perhaps did historically. In particular, in our Asian markets, we're seeing a very low level of price growth. It's as low as it's been for 5 years at least. And that gives us some confidence, because that should return, that should normalize. So in markets like Indonesia and India, we're not seeing the levels of price growth just now that we have historically. So where is that price growth coming from? And the answer, of course, is Latin America, where for example, Brazil it moved into a very difficult phase, very strong recession, but there we've got Sort of low double-digit high double-digit volume declines now, and about 10% price. And in Argentina, where we've got sort of mid-single-digit volume declines, but 50% price increases. So I guess what I'm saying, sort of a long answer, but it's a big patch. There's an awful lot of volatility there, but how we do it is because we have access to a portfolio, and being able to deliver that consistency of result through that volatility with the depth and presence we have, I think is fairly unique.
Any questions? At the back first.
With higher growth and lower margin in emerging countries, do you think that it become more and more challenging to improve margin in 5 years? Thank you.
Sorry, we couldn't see where it came from, but there we are, a wee bit disconcerting. Thanks. I'll give you my reflection, and maybe let Alan give his reflection as well, as somebody who's in there, running a big part of our business. I don't think so. I think, again, it goes back to the similar point that we just touched on, that the levers that we have to pull remain the same levers. I mean, if I think about, when you wake up in the morning in a consumer goods business, what are you trying to do? First of all, you're trying to grow the top line. That gives you growth leverage, and that growth leverage is a fundamental driver of increasing the bottom line as well. Then you're looking to increase your profitability, and healthy profitability growth, of course, starts with gross margin. And probably the most healthy comes from driving the mix within growth margin, and we would typically look to deliver somewhere 20, 30 basis points of mix every year in our growth margin appreciation. So the levers that we're pulling now, I touched on it earlier, but the things we have to invest in to fuel that are quite fundamental. The $1 billion of savings that we deliver every year within our supply chain, which are largely competed away or invested in pricing and devaluation, etc., all of those things, that takes investment. We spend a similar amount of money in R&D, and as I just said, we invest above the benchmarks typically in R&D, but that fuels both our innovation program and it fuels our ability to access those savings. So it's not as if we don't have to do a lot of work in order to keep the flywheel moving, but if we just concentrate on that and then moving down the P&L, concentrate on the efficiency programs, and as I said, ZBB is just the next wave of fuel coming into that hopper. If we can keep that moving, it's the same levers going forward. It does become harder because the volatility is there, but again, we're trying to deliver a consistent result across a broad portfolio in a world that's becoming more and more inconsistent.
I'll take Graham up on his invitation and share maybe a more empirical answer, which is, having spent large parts of my career in China and Africa, Middle East, places like that. Although we start from slightly lower margin, I think the ability to consistently improve your margin each year in those markets is less constrained than in the incredibly tough developed markets, where you're dealing with a fundamentally low growth environment and an extremely difficult trade structure. So I'm highly confident that our ability to continue to margin up our business in the emerging markets will overcome any mix effect of the faster growth from the emerging markets. It's more of an empirical answer, but just the pressure on the bottom line in Western Europe, North America feels more intense than in other parts of the world.
Hi. You referred in your presentation to the growth of agile and insightful local competitors in the last few years who've taken some share. Do you expect the efforts that you're making to combine the best of being global and local to start putting a lid on that growth and maybe squeezing it down, or are there reasons why growth in those local competitors is likely to continue for the foreseeable future?
I think we will all do a bit of chatting on this. Andrew can probably chip in as well. I very much hope that we don't slow each other down, because fundamentally in the markets that we've been talking about for most of the presentation, the key thing is to grow the market, to grow the consumer habit, to as we call it, market development. And frankly, we're quite prepared as the market leader in many of these places to invest and see the market come up rather than slow down competition. We all benefit, and that's the most healthy thing that we could see. I'd also one other point I'd say is, although undoubtedly a feature is local and regional competitors being better equipped, providing better products, better communication. They've always been there, hasn't really changed, and it's evolved over time. The one thing I would say is that we're not actually losing an aggregate to local, so it must be coming from somewhere else, but we are having to make the sort of changes that Alan talked about just to make sure that we're ready for that ever-increasing battle. And frankly, it's very good for our business because it keeps us sharp.
Well, Graham nicked the exact 2 points I was going to say, which were it's all about market growth. And in aggregate, if you look across the patch, the two winners of share have been Unilever and the local players. And I profoundly believe it's because we are a little bit more deep-rooted in these local cultures.
If there are no further questions, I propose it's coffee time. Thank you.
Thanks very much.
Thank you, Graham. Thank you, Alan.